98. Then Greg came on board 2001, and that's when the real sort of value investing philosophy was started, I suppose. And so at that point, we decided to establish two portfolios, an income and a growth portfolio, to really showcase what you might be able to do. So there were it was partly educational, partly to show how you could go about managing a portfolio, and partly obviously to showcase what we were doing and hopefully build up a track record, which is actually how it's turned out. So over the years, we've sort of, I think, the growth portfolio has delivered about 10% a year, I think, after cost, and the income about 12%, compared to about 8%, I think, for the market. So both of them are a little bit ahead of the index. The income slightly better, and that's actually been the case as well since they became investable 3 years ago.
And the next evolution, of course, is to become listed investment options. So the Equity Income Fund is now available under the ASX ticker code INIF as an investable product.
That's right. So 3 years ago, they became investable as separately managed accounts, which means you were able to invest, and you still are, and we'll invest that money according to how the model stands at any point in time. But the income portfolio was also listed as listed equity. What do they call it? Exchange quoted managed fund. EQMF in June under the ticker, as you say, INIF, and so you can just go ahead and buy that, and that avoids a lot of, well, it's only a bit of paperwork, but it avoids what paperwork there is anyway.
Yeah, it's much easier to buy and sell. Now, James, we've got a couple of questions. Let's get to those, and we'll talk about specific stocks and circumstances in a little bit. So the first question comes from Vaughan, and he asked, do you have it up there?
Yeah. How is an InvestSMART income and growth portfolio going to give me superior performance in terms of regular income and some growth, as opposed to, say, an Australian Super or Host Plus fund? I need the investment to basically provide regular income, a pension, as the priority, while at least preserving capital inflation. Well, I'm going to dive in. Well, we can't give personal advice.
That's right. Yeah, let's say that.
Second point is that preserving capital is the tricky part, and preserving capital inflation indeed. So what we're saying is we want to get a decent income without taking any risk, and that's not really possible. So perhaps that's not what Vaughan meant, in fact. But it's important to understand that these are equity portfolios, and equities have, over the long term, produce good returns, and that's why people like to invest in them. But they're not without risk; they can go up and down. So moving on then to the main question. How does it compare, or why would you invest in these as opposed to Australian Super or Host Plus? Well, the answer is because you think that they perform better, and that's the reason for investing in them. So I would tend to think of industry funds as being pretty much like trackers, passive investments. They're very large, and they and credit to them for that. There's nothing wrong with that at all. They have low costs, and they're passive investments, and they serve a purpose, and that's great. If you think that some managers might do better, and we like to think that we've demonstrated that we can, then that would be the reason for investing in our funds. And that, so far, that's been the case with these portfolios since they became investable 3 years ago. And we hope that continues.
One of the big differences, I'd say, between our funds and a superannuation fund in particular, but another fund more generally, is that we aren't constrained by any mandates to invest in particular stocks. So your super fund has to put some money into banks, it has to put some money into telcos. They are index aware. So what the market does impact how they invest their money. So if they have a negative view on banks, they can't just not hold banks. Whereas we have the option of investing in any way we want, regardless of how the index performs. And you can see that from the construction of our portfolios. We own 8% banks compared to about 22% in the index.
That's in the income portfolio. In the growth, we haven't got any banks.
And in the growth portfolio, we have zero allocation. There'd be very few superannuation growth funds. I don't think there'd be any superannuation growth funds who didn't have banks. We have so much more freedom, and we have that freedom because A, we're not on platforms that tell us where we can invest. We're not rated, so we don't have auditors telling us where we can invest, and we're small, so we can be nimble and we can do as we please. And that independence and that freedom gives us much more scope to outperform. And as you say, James, you can see that from the last 15 years of results. Now, the next question comes from Ian, who asks, how does Intelligent Investor portfolios interact with those of InvestSMART? Why would one invest in II portfolios as opposed to InvestSMART? James, there's an easy answer for this.
Well, again, it comes down to that passive-active thing that we were just talking about. So the InvestSMART portfolios take a fairly passive approach. So they're aiming to keep costs low. So they charge a low fee themselves, and they invest in very low-cost ETFs. And the idea is to provide the return of those underlying assets with very little leakage in costs compared to other providers in the industry. So compared to their peers tend to charge more. The average fees across the sector are higher, and so those other funds tend to perform worse. So those are all the arguments around passive funds. The intelligent investor portfolios are active. So you know, if they perform well, they'll do better. It's as simple as that. But if they don't perform well, then they'll do worse. And you know, that's really, you know, the question. So the question is whether you're going to back, you know, our value investing approach, or whether you want to take a more passive, low-cost approach. And both, I would say, are very sensible options.
And passive investing has been very much the popular choice.
Yeah. It's been increasing, and massive, for good reason. Yeah. The other thing to say about the InvestSMART funds is that they're sort of not necessarily 100% equities, the underlying funds. So they invest across different asset classes to provide you with different investment options. So when you look at those funds, you want to consider, you know, one of them is, you know, conservative balance. You want to consider what type of investor you are and what you're trying to achieve, what your goals are. And you can do that by putting your assets into the portfolio manager on the InvestSMART website, and then that might, you know, that'll help you to formulate those, get an idea for that.
Yep. So the difference there is just active and passive investing. The next one comes from Peter D. How does their performance after fees compare with their benchmarks? James, we've covered this quite a bit, but should we break down the performance in a bit more detail? Because the timing of performance, I think people don't pay attention to that as much as absolute numbers. And absolute numbers tell you something, but they also don't tell you something.
It's all on the InvestSMART website. So I'm just trying to find, if you go on the InvestSMART website, it says Invest With Us. Performance to June, I'm just scrolling down, performance to June 2018. So that's got 1 month, 3 months, 6 months, 1 year, 2 years, 3 years. So it's all broken down very precisely. Since inception, both portfolios are outperforming. So the equity income has provided 12.4% after costs, and the equity growth 11.3%, and that's compared to 9% for the ASX 200. So that both are well ahead. It's fair to say, though, that a lot of that performance came in the first year, and since for the last 2 years, I think we've been pretty much tracking along with the index. Just down 0.5% over 2 years for the equity income anyway. And look, we make no bones about that. That's how this goes. You've got to take a long-term approach. The last couple of years has been, I suppose, quite difficult for investors that aren't prepared to pay huge multiples for things. It's been quite difficult the last couple of years. But you know, we've stuck to our knitting, and we've got a portfolio of good stocks, and they've largely you know, performed well. And that's just kept us up. Now, if we can keep up with this kind of market, then I'll be happy, because I think we'll probably perform a bit better if things got a bit harder. But you know, that's, you know, times will get hard, and we will underperform from time to time. But
one of the things to remember is with that performance number, we present that performance number to you, and the industry does, as an annual number, but it's not generated annually, if you like. So your expectations of returns need to be, in an active managed product, need to be a little choppier. So there'll be years where we beat the index, there'll be years where we don't beat the index. what we're saying is over time, and we have the track record to demonstrate this, I think, over time, if you're patient, we expect to beat the index. That's what we aim to do.
Yeah, yeah. And
if we didn't do that, if we couldn't do that, James, we would
go and do something else.
Go do something else.
Yeah, that's right.
Why bother?
That's right.
Yeah. Now, should we take a little break and talk about some of the hot and not so hot performers that pop to mind? We've had some controversial buy and sell calls over the last 3 years. One of the most fascinating has been Flight Centre for me. Flight Centre entered both portfolios under a hail of fire, and I would say controversially, because it was not a popular decision when we put that into portfolios.
Well, there was, as they say, there was a narrative, wasn't there?
Yeah.
And you love narratives.
I do.
And we all have a narrative, because at the time, bad pessimism feeds on itself. If everyone's negative about a stock, then journalists just don't like to write positive stories because they feel a bit daft to do so. People like self-reinforcing things, and so pessimism. Sometimes, I'm not saying this always happens, but it can build on itself, and I think that was the case with Flight Centre. It was only a couple of years ago we upgraded.
Oh, it was 18 months ago.
18 months ago.
Yeah.
And everyone hated it.
Our own members hated it.
That's right. It was going through some tough times. The earnings, Flight Centre's earnings, and it's actually shown this over the last 15 years. There's been time and again where it misses these override payments. It has a bad year, doesn't meet certain targets of selling tickets with airlines, and misses out on a large chunky bonus or bonuses, and that can really hurt profits. And so that happened, and so profits are undefined. Then you see it feeds on itself.
People start questioning
the business model.
Yeah.
So internet's killing the business, and all these things. Because everybody it's a license. Anyone who's got a negative view has the license to really express it, and anyone who's got a positive view kind of keeps quiet because
they look silly.
Well, they look silly, and they got fed up of having their heads bashed. Anyway, so it's in that sort of environment, and this is what it means to be a value investor. You have to stick your neck out. You have to be prepared to people to come along and chop it off, and you take comfort in the fact that you're hoping to have the last laugh. And look, sometimes people go on and chop your head off and you don't get the last laugh. But sometimes you do. With Flight Centre, I think we have had the last laugh, at least in this, because we've sold it now. So this one's worked out well for us, and we can say that we put it to bed. But look, some work out, some don't. But this was one which felt good at the time. That level of negativity is always a good sign, I think.
I bring this one up because it does show the very stark difference between a value active manager and a index fund. And an index fund is, or a passive investor, is sort of forced to sell something like Flight Centre as it falls along, as the stock price falls along. Well, as its position in the index gets lower, they would
but their holding falls at the same rate as the.
Okay, but on the marginal
But in terms
dollar,
of flows, it's in terms of the
dollar
flows, the new money that's coming in and out, they'll be buying on and not buying. Yeah, that's right.
And that's an unthinking decision. So the price of the security of the market will dictate the marginal investment decision.
Yeah.
Whereas for us, we only want to buy something if we judge it to be cheap, and that means a whole sort of different series of decisions. But that's the sort of process, and that's the difference between us as an active and then your typical passive investor.
Well, South 32 is next on the list, because I'm looking. This is our quarterly update,
right?
And next on the list of performers. Second for the income, actually, and third for the growth is South 32, and it was exactly the same story with that, really. And I suppose and Macquarie Group, actually, which is also up there. All three stocks, there was a negative narrative at the time. So Macquarie Group, we upgraded about $60 when the markets were going through a bit of a nasty period, and everyone was saying they weren't going to be getting any performance fees that year and all that sort of thing. And that negative narrative takes hold. But the important thing for all three of those stocks is that they're actually quite high quality. So they have the staying power to pull through. So South 32 has some of the best quality mines in the world. Correct me if I'm wrong. Macquarie Group is obviously a very high quality investment bank, and Flight Centre also has great quality. It's shown its ability to come back year after year. So I think quite often when you invest in these these negative narratives. There's a lot to be said for that, for having that underlying quality to recover with.
Now, we've talked about one that's done really well. Let's talk about one that didn't do very well over the year. I'm thinking of a MASIM in particular, which we held in both portfolios and took a 50% bath on. I mean, are there lessons that we've learned from this, or is it just the case that when you're buying stocks, some of them just don't work out?
There's always lessons to be learned,
Yeah,
I think.
so.
But sometimes you also get unlucky. So it's hard to know the difference. I actually think that a MASIM is more of I think that the investment case for that was reasonably sensible. I think things just didn't work out, as you know, and look, you can blame some of that on us and some of that, sometimes events just conspire against you. I think our mistake with the MASIM probably to hang on too long. I suppose we favour sort of, once a holding is in our portfolio, and unless things have materially changed, we tend to give them the benefit of the doubt because we don't want to overtrade. But
it's also a very difficult balance because one has to, the price you bought at needs to be forgotten after you bought it, right?
Yeah.
What matters is price and value at the time.
Yeah.
And if the price is always changing, the value is always changing. It's always a balancing act between those two.
That's right.
So you have to weigh up the negative news against the falling.
But I think that while your original investment case remains intact, then you give it the benefit of the doubt, and there comes a point where you should decide that perhaps your view of it's just not working out, and that therefore you probably have no better view over the market, and it's probably time to move on. And possibly we could have got to that decision with the MASIM a bit sooner. I would say, but I would say overall the decision was, I think it's more one of those things. GBST is probably the one I'm kicking myself most about. That's the worst performer I think in both portfolios. Second worst in the income and the worst in the growth. But for me, that was one where I just misunderstood. I got the revenue model wrong with it, really. I was taking historic market share, sales made years previously, as a sign of quality, really. Whereas, for businesses like that, which have large one-off sales and then annuity income, really the market share was reflective of previous product strength, not of the existing product strength. And the market got that one right and I was wrong. And so that one, I think I learned plenty from that experience.
But there's a great point in there. I mean, the idea that you have to make money on every single investment needs to be banished. What matters is your portfolio returns, and if you're investing in stocks, you are going to lose money on some of them.
Yeah,
and I think what we're quite good at doing, James, is providing comfort with that idea. And a lot of investors, I think, are still very scared of losing money on an individual stock when it's the portfolio returns that matter.
When I wrote an article, painful lessons from GBST or something, just going through some of those lessons. And the analogy I drew was when I went into a bike shop once, and I told the guy in the bike shop, this was for a commuter bike I was rigging out to get to work and stuff, and I said I wanted the most puncture-resistant tyres he had. And he looked at me, he said, you do not want the most puncture-resistant. You think that's what you want, but that's not actually what you want. If you want that, I'll just give you a strip of rubber, completely solid rubber, which is never going to puncture in a million years. But it's also going to give you a terrible ride. It'll be slow. You'll end over work sweaty, and it's a terrible answer. So, you have to be prepared to suffer the occasional puncture in return for having a good, smooth performance otherwise. And that's the same, I think, here. You can't underwrite every situation. If you were never prepared to take losses, you would have a portfolio that's 100% in cash. Which probably feeds to the next question.
Let's carry on. There's a good question here, which we get asked quite a bit, actually. I noticed a lot of stocks in common in both portfolios. What are the key differences, and how do you screen for income in the income portfolio? Now, James, this is, as I said, this is one that gets asked an awful lot. What are the big differences between the growth and income portfolios?
Well, the growth, historically, and now, so this is, we set up an income and a growth portfolio for those reasons, because we understood that there were some people who are particularly focused on growth. Normally that's people who are in the sort of accumulation phase of wealth, who are trying to grow their wealth. You probably aim for slightly higher returns from those sorts of assets, although that's not been the case with these portfolios. It's been the income's done better. But there are other people who are trying to draw an income from their investments, and they're sort of in the retirement phase, if you like. And so that's why we have the two portfolios. But yet we're value investors. So we're not income value investors, we're not growth investors, we look for value. Now you could have value in a growth stock, you can have value in an income stock, it all just is all just a question of the future cash flows and what they're all going to be worth. So what we do is we hunt for value, and when we find value, we look at the stock, and if it's got a good balance of income, and by income we don't necessarily mean a dividend yield, that's just the number produced by the directors. What we want to see is strong cash flow generation relative to the price we're paying, and ultimately we presume that cash is going to come to us somehow.
Let's just discuss that point, because that's a really important distinction. I think when people hear income portfolio, they think we merely screen for the largest yield, and a company has to have a specific yield target for us to include it.
I'm happy to buy for the income portfolio. Happy to buy a company that pays no dividend.
Well, we've got some of those.
Yeah, that's right. Do we? And News it pays a small dividend. It pays 1% or something. It's tiny, but it generates excellent cash flow, and we think growing cash flow, and we think ultimately, we're not we're not investing to produce a yield from the portfolio this year. We're investing to produce a portfolio that can generate an income over 5, 10, 20 years, and for that, it's good to have, and we want that income to grow in line with the economy as well. That's important. So you need to have some companies in there that are growing, as long as they've got decent cash flow, and if they're investing that cash flow to build for the future, then we're perfectly happy with that. Having said that, we do try to because all of this, we're just talking about value there as well, so all of that applies to the growth portfolio as well. But with the income portfolio, we are trying to produce a yield that pretty much matches what the market delivers, which at the moment is about 4%. It's probably gone down a bit actually, but so we're trying to match the market yield, but have a yield which grows at least in line with the economy, and it's that at least, I suppose, that would probably hopefully provide our outperformance over the long term. Now the growth, so when we find a good opportunity, we look at it and we say, now, if that's got no yield and it's highly risky probably, then we'd say, well, that's Nanosonics would be a good example. That's one for the growth portfolio. The income portfolio, the type of investors that are investing in that portfolio, probably not interested in Nanosonics. But if it's got a decent yield, something like AL Property, for example, is one more suited to the income portfolio, probably the growth people in the growth portfolio. Although we have had that in the past in the growth portfolio, but when it was a much more compelling value opportunity. So now, we still think it's an attractive stock. We think it's got good value, but probably not quite the return hurdle that we would have for the growth portfolio.
So we don't have specific screens either for growth or for income. We want to maintain maximum flexibility, but there are subtle differences to the approach when looking for a potential placement in the growth or income.
And so I suppose, both stocks, both portfolios have something like 25 holdings, sort of 23, 25, something like that. And I think 17 or 18 of them are in common. But that extra 5 or 6 makes quite a difference.
Yes.
If you include 5 there and different 5 there, that makes quite a...
So you're actually likely to see quite a lot of commonality between those portfolios. But as you say, there's going to be, the differences are important differences.
Well, with Flight Centre, for example, it's a great cash flow, it offers growth, it's a quality company. We have that opportunity, and we're not going to deny it to either portfolio. So you're going to buy it in both, and that's why you're going to have a large overlap. A lot of the companies we look at are suitable for both. They provide both good returns and a decent income. So
now there's a question here also about the level of cash. It's unusually high at the moment, about 14%. That is a result of some recent sales. And James, it's not. We don't have any targeted cash level, do we? We like to keep maximum flexibility around cash as well.
Yeah, the position I prefer to be in is fully invested, and if we have something to buy, then we have to kick something out. That's the ideal situation, because then you're always competing for your sort of best ideas. At the moment, markets the way they are, it's slightly harder finding new opportunities. But if you look back over the past year, it's been quite hard. But opportunities keep ticking over. We've had Woodside, West Farmers. Opportunities keep coming, but at the moment so we've sold more than we bought, and we don't want to rush. So yes, 14% is a bit higher than it's actually a bit higher than that now, in fact. But yeah, I mean, I would prefer to see the cash levels down in the mid-ish sort of single percent range or even less. So it's unusual, and hopefully we'll get that lower.
It's probably instructive to note that we don't target cash levels. If we don't look at interest rates or tariffs and think, oh no, we must go to cash. That's not really the way we think about things. The cash level is just, there's a bit of logistics involved there. If we've recently sold largest holdings, as we have done recently, then the cash sort of sits there.
Yeah. It's just a function of an efficient portfolio. So if there's something you want to sell, but there's nothing that you want to buy then the result is cash.
Yeah, and I mean, we are, both of us, we want to put that cash to work, and we don't want to hold
cash over the long term doesn't provide great returns,
disaster.
and we'd rather be in shares.
Yeah.
But we'd rather be patient and get in the right shares.
All right, now look, is there anything else we really want to add, James? I think we're bumping up against the close here, and we should probably let people get back to their lunches. The INIF product. Now, it's important to note that the exchange traded fund is exactly the same portfolio as the SMA product.
Yeah.
So there's no difference between those two. When you're buying one, it's really just a method of distribution that changes. It's the model, the portfolio is actually the same.
Yeah. So the way that works is that it's an open-ended fund. Well, you buy it to private investors, to retail investors. It operates like a closed-ended fund, but it's an open-ended fund to institutions or to the market maker on the fund, and that means that it gets bigger and smaller as people invest in it, but the price holds. The point I'm trying to get to is that the price
really
holds
point.
next to the net asset value. So it's in line. So you don't get the premiums and discounts that you can get with listed investment companies.
Very important. So unlike LICs, you're not going to see this fund trade at 20% premium or discount. It's always going to trade as net asset value.
You buy it on the market, and you'll get very close to. I think the requirement is that we keep within 1%. I think
I think it might have been less than that, in fact.
Maybe
but it's
stays very
close
to the net asset value. And so that provides some comfort. And the fees are the same, I think.
That's right.
I know.
Yes. Yeah. All right. Well, look, we'll leave the questions there for now. If there's any more questions you have, send them through the usual channels. We're on all sorts of fancy things now. We're on what are we, James? We've got Facebook, we've got Twitter, we have the good old phone line, and we've got email as well. So if you have any other questions, the Q&As as well.
Q&A,
that's probably a nice way to do it.
The normal way. Yeah.
That's probably the best way, actually.
Right.
Do what I said last. Do that first.
Awesome.
Okay. Once again, apologies for the delayed start, but thanks very much for sticking with us. And thanks very much for watching.